So thank you everyone for coming to the kind of like the start of the 6 years of accounting design project. Steve, would you like to kind of like give an opening remark?
No, but I will. um, well, welcome again to the. You say it's the 6th year of this. So this is something we started during COVID to get us all together, but with a particular mission in mind that to bring forward research which actually is aimed at accounting design as we have it, as we say it. That is looking to get better accounting, understand what's good accounting and what's bad accounting for particular purposes in mind. Thank you all for your attendance over the years, and we hope that this will continue in the future. We had many submissions this year, and we hope that, that for this semester, and we hope that'll continue in the future. Please send us your submissions at the beginning of each semester, and we'll pick the best of them, so the audience is treated in the best way. So, okay, let's go. Another semester of ADP.
Thank you. And then Ilia doesn't require any introduction, so let's just go right into his presentation. Yeah, Ilia, would you like to the first few minutes uninterrupted, or do you welcome questions?
I think it would be nice to hear the first few minutes interrupted to kind of lay out the main argument. The paper is not long, the presentation not that long, so we'll definitely, I think we'll have time for questions to pitch in. But without laying the main argument, I think it's best to have some interrupted time in the beginning.
Okay, perfect. Yeah, so let us know whenever you welcome questions. Yeah. Mm-hmm.
Okay, should we get started? Yes?
Mm-hmm. Yeah.
All right, first, hello everyone. Nice to see you on the video. I'm delighted to be here, and I thank the organizers for this opportunity. I think it's perfect for this kind of paper. This is not the paper that usually you can present in a regular workshop. And also, I just finished writing this paper over the summer, so I'm really excited to present it. It's early and it might be rough in places, but I've been thinking about this for a long time, and it finally being able to lay down some thoughts about it. So I'm really looking forward to the presentation and your comments. So just to make sure you can see me, yes, you can hear me, you see the screen, yes, everything, okay. So let's roll right into it. So the paper is about accruals, and so with this audience, I don't need to spend much time on the motivation. The accruals a key concept for us. This is, as I was talking to Michael earlier, this is our bread and butter. We should really know accruals. This is our value to the world. So I felt strongly about this for a long time. And I think it's the accruals also the difference between cash accounting and accrual accounting, which are the two main systems of accounting. So key concept on number of dimensions. And so what's interesting here is that the concept of accruals actually is not well nailed down, as you would think, for such a critical concept. And a few years ago, Larson, Sloan, and Jagged had a nice review about accrual research and about the different measures of accruals that are being used. And it's fascinating to read it. If you haven't seen it, I recommend it. You can see how the literature kind of going around different ideas about accruals, try to figure out what's going on. So we started working capital accruals, and then we say, well, should we have depreciation there? Okay, we should have depreciation in there. That's an accrual, all right? But then wait, if depreciation is an accrual, is PP&E an accrual? We're not sure about this. Some people include it, some don't include it. And then, but if PP&E is an accrual, what about other long-term assets? How about financial liabilities and so on? So there was this unsettled state of literature for a while. And the big contribution here really is Richardson, Sloan, Solomon, and Tuna in 2005, which is a great paper. And, no matter what I say after, there's some criticism and further development. But that paper really kind of nailed down this topic, at least in its current iteration. And so what they proposed is accruals is basically very simple. I say accruals are the changes all non-cash assets and liabilities. Okay, and it was a great achievement because this kind of confused state finally became clear, and the concept was very simple. It's comprehensive measurement of accruals, all assets and liabilities at cash, and it's rather measurable. So it was very clear what to do from here on. And because of this attractive feature, this is pretty much the dominant notion of accruals today. And I would say maybe it should become too dominant in the sense that it's not so much the problem of the idea itself, but I think simplified and mechanistic application of it can lead you the wrong way. So you'll see what I mean in the following slide, but to give you some preview of coming attractions here, my main claim here is that the RSST concept, or what I call the balance sheet oriented concept of accruals, is not wrong, nothing wrong with it, but it can be inadequate for certain purposes. For certain purposes, it's fine. For the purpose, it's not, and it can be even misleading, leads you the wrong way. And at least my take on it is that the RST concept is about the net effect of the accrual process over a given period of time. That's how it's typically used. And it should be taken more as a measurement perspective. You can measure accruals with it, but be careful what you're measuring exactly. But it's not a good guide to what accruals actually do, and that's where you can be led astray. And to give you an example of the possible mischief that can happen here is, let's say that you look at this balance sheet oriented concept of accruals and say, well, how do I want to have good accounting, right? This is, say, accounting design project. What would you do with accruals to have good accounting? So to have good accounting, you probably need to have good accruals. And if accruals are the changes in assets and liabilities, then to have good accruals and good accounting, it seems to imply that you should have quote unquote good changes in assets and liabilities. And then if you need to have good changes in assets and liabilities, it seems like you have to have good levels of assets and liabilities, which basically strongly takes you to some kind of valuation perspective on assets and liability side, or a balance sheet oriented exercise. Accounting basically becomes a valuation exercise. I'll value the assets and liabilities, and this will produce the good accruals and good accounting. And I don't know how this sounds to you, but to me that for a while, oh, there's something wrong here, right? I just don't think this is the way to go. Well, partly on a taste level, of course. But let me tell you how, my thinking went. Well, what is the right? If you step back, what is the right way to think about these things? All right. So Steve has a question.
Yeah, Ilia, I know you've given a lot of thought to this over the years, and have contributed significantly to it. Here's a question for you, however. You're accepting this standard you call it a Sloan definition of accruals, okay, which is changes in the balance sheet items.
Yes.
Okay, so let's think about change in accounts receivable. Accounts receivable is debited with the revenue accrual. It's credited with cash. So if in fact we have more cash payments on the receivables, do the accruals go down? Isn't that a function of the cash, not the accrual?
I'll get straight to that. How about let me do a few slides and let's.
Okay, sure. Go ahead. Sorry.
Okay. Because actually I'm using accounts receivable. So
okay, good.
So broadly speaking, where I think this is going and what my motivation is that accounting is interested really in reflecting the success of firm operations. So this is the important word here, right? So the resources, the balance sheet is really like a support for the resources, for the operations. But the important thing, the operations, that's how managers, analysts, investors view the firms, and that's how they value them. So what are operations? Again, broadly speaking, operations are about executing some kind of business model. Let's say this is a retailer, you're selling some goods, procuring them, paying them, laying them out, selling them. And the idea is that whatever costs you're incurring to execute this business model, you're going to earn more revenue than that, and that will produce some profit, right? So profit is the key idea here. And it's not accidental to talk about for-profit entities. We don't talk about for-asset entities. We talk about for-profit entities. This is the key word. So the focus is, if you're going to be thinking about the successful operation, the focus is naturally on the income statement and income, right? And then, well, what kind of income is possible as a measurement here? The simplest is cash flow accounting. So cash comes in, that's revenue and income. Cash comes out, that's expense. But there are well-known problems with this kind of cash measurements of income. Dichev 94 is a big paper here. She calls them the timing mismatching problems in the cash flows. Basically, cash flows, they might provide some utility, like you buy PP&E, it provides some utility in the future. And if you expense it immediately, that's a problem as a measure of performance. You have this huge cash outflow. It looks like a loss, but it's not. So broadly speaking, again, the idea is that we're going to use the accruals to modify the recognition of cash flows into income to produce a better measure of performance. All right. And so how we're going to do that, again, just going to remind you about a couple of identities here. So broadly speaking, accrual accounting is cash accounting plus the accruals, or in terms of income, income is equal to associated cash flows plus associated accruals, and just depends how you define the income. Is it a component of income like revenue or bottom line income? You have to be careful there. And as a classic accrual, we use a revenue accrual. So revenue is equal cash collections from customers plus change in accounts receivable, assuming they are not deferred revenue accruals. Okay, so nothing controversial here. And let's look more closely how this looks like. So the idea was that accrual accounting will be modifying the recognition of cash flows into income. And here's a classic example. This is exactly what Steve was talking about. Let's say you book a receivable for $100 at time T, and then you collect it at T plus 1, okay, $100. And so if this was cash accounting, revenue will be recorded in T plus 1, right? Okay. But if you practice accrual accounting, after you do these entries, revenue is recognized at time T, right? So what accruals did for us here is they moved the recognition of revenue from time T plus 1 to time T, okay? And that's basically what accruals do with respect to the income statement, all right? Any questions so far? I mean, this is pretty straightforward, but even with these simple entries, if you look at it more carefully, it actually eats quite a bit of insights. So the point here is not just that accruals affect the balance sheet accounts here, right? That's the balance sheet perspective. The accounts receivable are here, but it's really that these entries go together, right? The two accounts receivable entries go together, and it's the combined effect which produces the recognition of the $100 into revenue at time T, okay? So this is what I mean here. The accrual adjustment work in pairs. This is the first big fact here, and that's well known, so I don't need to spend much time on it. But what is new here, and I think we have to be careful about the language here, is how does this exactly work? Okay, so let's stare at this a little. So the first thing, when you're going to move the recognition of this cash flow of $100 from T plus 1 to T, is you have to defer the recognition from time T plus 1 to somewhere else. That's what the second entry is doing here, okay? So this second entry is deferring the recognition from time T plus 1, okay? And how is this accomplished? Well, if you're recording an accrual with the same amount at the same time and the opposite sign, right? If you want to defer recognition of the cash flow, the accrual has to be with the opposite sign in the same period, okay? So I call these accrual adjustments. I call these deferrals. All right. So deferrals, that's one problem here. Deferrals is kind of a nebulous term used differently in different places. But here, in each accounting pair, there's a deferral and what I call accrual proper. Okay. The deferral defers the recognition of the cash flow to some other period. This is the second entry here. I'll be with you in a moment, Steve. And then the other side of the entry is where it accrues the recognition in some other periods. Okay, that's in time t here. So this accrual, and that's what I call accrual proper, it accrues the recognition in some other period. So in other words, the recognition of cash flow, moving it to some other period, has two steps. One is deferring it from the period in which the cash flow occurs, and the other is accruing into some other period. And this is the image illustrated here. Okay. That's what the next slide here is. You defer recognition away from a period into another period. Sometimes the deferral appears before the accrual proper and sometimes after. In this case, the accrual is first and the deferral is second. Okay? All right, Stephen.
Okay, I don't want to monopolize the conversation here, but now that you got the accounts receivable example up, you're defining earnings as cash flows plus accruals, right?
Yes.
But you agree that the change in account receivable, accruals are the changes in the balance sheet accounts.
Yes.
Change in accounts receivable is the revenue recognized under accrual accounting minus the cash flows. Okay? So it's cash plus accruals minus cash flows. So if in fact, in your example here, that T1 plus 1 cash flow of 100 was actually in period T, a year, then you say accruals are 0.
Wait,
Screwed up.
I didn't get the last part. So the cash is in T1, T plus 1. So what is your...
No, if in fact you
Yeah.
recorded the accrual of accounts receivable in T and they paid it off in T, okay?
Yes.
Under your definition of accruals, the accruals would be 0.
Well, I mean, you're basically saying that the accounts receivable originated in the same period, was collected in the same period. So from
Yes,
the
very often it's a year. Periods are usually a year or a quarter.
yeah, so
Usually 30 days receivables.
yeah, that's right. Accrual will be 0 from the point of view of the period.
So you're defining accruals as the revenue recognized minus the cash flows received. That doesn't seem to be an accrual to me. That seems to be something driven by cash flows. So if in fact we had the accrual in period 1 here of 100, but in fact they paid it, the accruals would be 100. But if they paid it off in period T, the accruals would be 0 in the change of the balance sheet.
Yeah,
It's a confusion of cash flows and accruals. If you defined accruals as the change in the balance sheet.
No, I mean,
That is straightforward. That's straightforward algebra.
So this is the kind of things that I think the balance sheet approach basically gets confusing about. So if you define this in discrete moments, so you don't have like a quarter, you have every day, this still applies. Over the course of the quarter, if you collected the accounts receivable, yes, the accrual is 0. So it's the same as a cash sale. No problem there.
But isn't the accrual the recognition of the revenue? It's under the, if you look at the revenue recognition standards, it has nothing to say about reference to cash flows, only to future cash flows that they must be fairly highly certain. Okay. Cash flow does not come into the recognition of revenue. The recognition of revenue says you've got to satisfy contracts and so on. Okay. If you get cash, that's not part of revenues, because you then got to ask, is it revenues are recognized this period, or is the obligation not satisfied? It's deferred revenue. So the revenue that comes in is never the cash. It's always the revenue recognition principle that says, I don't recognize cash at all unless certain criteria have been satisfied, and they're the accrual accounting principles.
I don't think
It's a simple point in my mind to see that the change in accounts receivable is partly driven by cash. If you get cash, you get lower accruals, and that seems very strange to me. That seems very strange to me that cash drives accruals.
it does.
Okay, well, now you can call accruals anything you like, okay, but then it's a question of how you employ that to get insights.
Oh,
And it's okay to call accruals.
Different thing, but otherwise, I mean, there's no problem, right? If you have a cash sale, do you have revenue? Of course, right?
But
Of course.
only if the revenue recognition principles are satisfied. You get cash and you haven't satisfied the obligation. It's not a revenue, it's deferred revenue.
Say that again?
And if you get cash
Yes.
and the revenue recognition criteria have not been satisfied, the contracts have not been completed by the company, you have to record as deferred revenue. So what is recorded is not cash. Cash never gets recorded. It gets recorded if, in fact, the revenue recognition principle is satisfied, and that has no reference to the cash.
Yeah, there's no problem there. I think we're talking about the same things with slightly different language. But from the point of view, the way this is usually done is with the products of the financial statements, which are over a quarter. So in your case, whether you have cash sale, we have accounts receivable, and it was collected by the end of the quarter, the accrual is zero. So
okay, so you're saying if you collect cash, the accrual is zero. Okay, so accrual
over the period, over the period, over the period.
Over the period, yeah.
Yes.
Yes.
Okay, but let me roll.
I'll get out of your way now. I'm sorry.
I mean, one important thing here is, just like with the RST notion, it's not that the notion is wrong, but what do we apply it and how? This is what I'm getting at here. Okay, so I'm not trying to prove that the balance sheet version is wrong. But let me show you why this, I think, makes sense and how you can use it better. All right? And I'm getting to that. Okay, let's see. Jim has a question. Jim Olson. Jim, your hand is up. Well, I think we're on.
So Dipta has a comment on the chat box. Dipta, do you want to
Okay, let's see.
unmute yourself? Yep, here we go.
Okay, so Dipta, go ahead, because
So I think you are making a mistake in calling it balance sheet method. I think this is the statement of cash flows, indirect method, statement of cash flows method. Because you're looking at the changes, which are the ones that reported on the indirect method statement of cash flows. If I was to think about it as a balance sheet, I'd be looking at the levels of accruals on the balance sheet, the levels of the non-cash items. So I think the change variables are essentially whether it gets reported in the statement of cash flows or not. I don't think it's accurate to call it balance.
fair enough. I mean, yeah, the labels are not that important here. But let me again roll a couple of slides. Let's see what you think of that, because it's what you're trying to do with this. Okay, so I mean, the main point here is that if you make this distinction, so when you're talking about accruals, I basically splitting them in these two types of accruals. One is what I call deferrals.
Oh.
So the deferrals, these are what defers the recognition of cash flow to some other period. And the accruals, so accrual proper, is what accrues the recognition in some other period, right? Why is this important? Well, because of their different function, these two types of accruals have very different properties.
Get rid of it.
This is the major point here. So in the example of the accounts receivable, deferring recognition of the $100 to some other period, it can be done only one way, right? If you want to defer recognition of something, you have to record an accrual with the opposite sign in the same period and the same amount. It's a tautology in some sense. So deferrals are very different from what I call accruals proper, right? Deferral, if you want to defer the recognition of a cash flow, it has to be the same thing in the same period, okay? You see what I'm saying? The cash flows are basically, if you take this to be kind of the basic facts of what happened in the business, they pin down the concurrent deferrals, right? You buy PP&E, if you defer it, you capitalize it, right? There has to be accrual with the opposite sign, same magnitude, same period. You spend the cash on PP&E, you booked it, it's a positive accrual, okay? This is very different. So this is, if you want the effect to be on income 0, and this is the cash flow, you basically cancel it out. All right. There isn't much room for discretion once there's discretion with respect to cash flows. That's a separate issue. But if you have the cash flows, the deferrals for them, if you're going to defer it, if you bought the PP&E, are you going to defer it? It's pretty clear what deferral should be, right? In some sense, these deferrals, these are like bookkeeping placeholders. They're really setting the stage for the other side. And the other side is very different. Okay. When you're accruing the recognition, it's somewhere else in another period. And it's a completely different thing. It can be in this period or it could be some other period, right? In this case, accounts receivable was booked in period T, but maybe it could be booked in T-1 or half of it in T-2, half of it T-1, right? You have discretion when to book it. You have discretion how much to book it for. Maybe you can book it for 110, right? Depending what you think about collectability, right? Maybe there are some, collectability accounts there and so on. But you see what I'm saying? If you're estimating something future here, you have discretion when to book it and how much to book it for, right?
So don't you have to worry about booking present values? So it's sort of, you need evidence for the interest rate.
Yeah, all of that's in play, right? That's an estimation, right? So if you...
But you can't record 110. I mean, you record 90 maybe, but okay.
Well, maybe the gross is 110 and you have a provision of 10 and things like this. But you see what I'm saying, right?
Yeah.
Let's say these are mortgages you're recording, receivables as mortgages, right? This is a pool of accounts receivable, not one accounts receivable. How we record it? Oh yeah, you can certainly have discretion there, right? So this is the big difference. This is what everything is revolving around. That when you say accruals and we say it's balance sheet changes, they're composed of two very different things, what I call deferrals and what I call accruals proper. And one has pretty much no discretion once the cash flows are determined. And the other is really where the discretion is. This is the real accruals. Okay. All the action that we typically think about accruals, they're in this what I call accruals proper.
So I think I'll challenge you on that. So in the case of WorldCom, say, they had, $6 million worth of cable and they capitalized it. So the cash was clear, but they still had a choice on whether to call it an expense or an asset. So I think you're oversimplifying.
No, that's just a different level of discretion, a different kind of discretion. I'm not saying this covers all discretion. So basically, decision to capitalize or not is one kind of discretion. But if you decide to capitalize it, how much to capitalize it for is clear, right? It's this cost. Well, there may be some final dance there, right? I capitalize this, not that. But you see what
from the expense perspective, it would not be a choice. You paid the 100 today, it's an expense today, right? So it's sort of that discretion is arising from how you decided to treat that cash flow, how you categorize the cash flow.
Absolutely, no problem there. Yeah. I hope you see what I'm saying. I think pension and OPEBs are a good example of what I'm talking about. Because pension and OPEBs have extreme discretion, right? You're estimating things which are 10, 20, 30 years in the future. So you have a lot of discretion there. When you're booking the expenses and the liability, a lot of discretion, you can be way off, right? But the deferral is when you pay it, right? When you pay the liability, sending the check to these retirees, you send a check for $1,000, it's pretty much what the deferral is. You reduce the liability for $1,000. There's no choice there. Okay. In other words, these are two quite different things. And I don't think this is well appreciated or known really, and makes a big difference. Okay. So the big implication from all this is that when we talk about accruals, splitting them into what I call deferrals and accruals proper is the way to go for all kinds of things, especially if you're interested in things like discretion, estimation errors, quality of earnings, all of the things like this.
So again, going back to Steve's example on deferred revenue, think about an airline selling tickets with frequent flyer points. The frequent flyer points can be converted into future flights. So there's an exchange rate there, and you've got to record the deferred revenue separately from the revenue. And there's lots of judgment involved in how much to book based on the probability that these passengers are going to convert these points into flights, et cetera, et cetera. So I think it's not quite as obvious as you're stating. If it's purely deferred revenue like a magazine subscription, I agree with you. But once you have a little bit more complication, I mean, as a combined bundle transaction, then a lot of discretion.
I mean, these are exactly the kind of things that I want to, hear more in these presentations and write them in the paper too. So I really want to be clear about the big picture here. Otherwise, when you get in the nitty-gritty, there's a lot of interesting angles here like this. I totally agree with you, Sudipta. So in addition, there are a lot of interesting, this is kind of the classic interest here that I presented, but there's a lot of variation there, right? So in some of these entries, it's not like just deferral and accrual proper. There could be a lot of accruals proper. Let's say if you buy marketable securities, you mark them to market. Each period, you're marking them up, right? Okay, or even better, if it's an estimate. You're just estimating and up and down. You're basically accruing things. So it's not one deferral, one accrual. They could be many accruals, all right?
But when you impair them, then you can't reverse it. So again, there's sort of another layer, but that's okay.
But you see what I'm saying, right?
I agree.
When you're buying them and you're putting on the books, it's pretty clear what you booked them for, all right? Later, it's a lot more discretionary, all right? Yeah, I have to think exactly how to write it, but this is a big, important distinction. I do feel pretty good about this. Okay, and that's kind of the main point of the paper. So let's see, how does this fit with the balance sheet concept of accruals or asset liability, or Sudipta will say that the cash flow doesn't matter so much. Well, it fits together in the sense that these are two sides of the same coin, right? Because the income statement and balance sheet articulate, and income changes attract to the changes of net assets. We know this. So in some sense, they're the same thing, sort of, yeah, they're the same thing. So they're consistent with each other, right? I mean, here in this entry I was showing, yes, the accounts receivable, these are balance sheet changes, and you have this shifting of income from the future T+1 to T, okay? So yeah, we're describing the same things, but, drum roll, please.
No,
Which one is better?
no, it's not the same thing because the revenue includes the cash revenue as well. So
What's then?
the revenue includes the cash revenue, the cash transactions as well. So this is sort of the non-cash transactions that you're picking up, right? The changes in the amount of credit. It's not the same as total revenue.
Oh, yeah. But I mean, all of these differences are with respect to where there's accruals. If you have, some accounting is cash accounting. Cash sales are cash sales, so nothing is affected there.
Yeah.
Oh, no problem. All right. So which one is better? I mean, it's a chicken or egg problem in some sense. If they're the same thing, it's, we could argue through each other and maybe we couldn't agree on it. But I do think there's some hints here. Okay. What are the hints? Well, look at this. At the end of the transaction, at the end of this particular transaction, what happened? What happened to the balance sheet changes? Well, they got zeroed out, right? In other words, the balance sheet changes, again, this is supposed to be the accruals, the important thing. By the end, they're gone. They're nullified. What happened to the income statement effect? No, they're permanent, right? So the balance sheet changes are transient and temporary, but the income statement changes are permanent. You shifted the recognition from T+1 to T, and it stays there. Okay, this is important here. If you think what is driving what, I would say that this is getting more philosophical here, and conceptual. But my reading, at least, is this is not about valuation of assets and liabilities. It's definitely not. Here, the changes in assets and liabilities, it's more the levels and the changes are really. This is keeping track for operations. I'm talking about operations mostly. This is more keeping track of anticipated and deferred revenues and costs. Okay, when you book it at PP&E, yes, it's an asset, but it's really unexpired cost. We just have to allocate it, right? We're not so much trying to value. There is valuation, right? It's on the balance sheet. But this is a key difference for operating assets. Accounting is mostly keeping track of this anticipated or deferred revenues and costs, all right? In other words, it's the operations, the cash flows, and the shifting recognition through accruals which drive the changes in assets and liabilities. It's not the other way around. It's not like we care too much about the value of assets and liabilities, and that produces the accrual.
Ilia, but the revenues are going ultimately to retained earnings. So, the other side is inequity. So, so I think you're, again, overstating. Once you close the revenues, yes, the revenues and expenses, income statement accounts are by design temporary because you're going to start measuring them again from zero the next period. But, you could do the same accounting without the revenues and expenses, right? You can just debit or credit retained earnings all through without the revenues and expenses.
Yeah.
So then it's just, they're going to the balance sheet. On the debit side, you're changing receivables. On the credit side, you're changing retained earnings. You can skip the revenue and expense parts.
No problem there either, but just the pattern recognition of these changes in retained earnings, if you want to call it, will be different over time. This is the
It'll be the same as the change. Yeah, it'll be the same as the accruals. It won't be the same as the cash flow.
That's exactly the point. Yeah.
Okay. So
again, it is a bit of a chicken and egg thing, but this is my reading of it. That the assets and liabilities are more of a props to the operations. They are not. This is not the end all of operations. They're kind of making things happen, keeping track of the costs, but it's not. We're not in the business of just having assets and making them grow. Okay. Is you probably getting the flavor of this? The problem, I think, with the balance sheet oriented concept is that it's not like it's wrong per se, but it tells you little of what accruals actually do, and that's what the income oriented perspective tells you. So, you know, as administration, what are the shortcomings of this? I mean, if you look at the balance sheet perspective, all increase in assets, they look the same, right? They are positive accruals, right? It's an increase in assets, that's a positive accrual. That's what the balance sheet oriented approach will think about increase in assets. And the income oriented view will say, yeah, they're positive accruals, but booking accounts receivable is very different from increase in property, plant, equipment. One is a deferral, the other is accrual proper. Very different function, very different properties in meaningful ways. And thus separating them really makes a difference. All right, let's kind of put this to the test, because ultimately for a lot of these things, I think there are different ways to visualize them, to talk about them. There's this chicken or egg aspect of it. But, you know, is it helping to think about some familiar problems better? Right? Here's one that early one was bugging me, and the answer is obvious in some sense. But so do no growth firms have accruals? Right? If you look at the financial statements, zero growth firms, basically assets and liabilities don't change. Do they have accruals? Seems like no, right? Because zero change, right?
From a balance sheet perspective, they do. It's only from a cash flow statement perspective that they don't.
Well, I mean, if the balance sheet is not changes, where are the accruals?
What's the balances on the balance sheet?
No, this is accumulated.
Yeah, so,
Remember, the definition of accruals is changes in assets and liabilities. So if there are no changes, there are no accruals.
but that's a statement of cash flows definition. A balance sheet definition would be all non-cash assets and liabilities.
Well, whether you call it, I mean, whatever you want to call it, but remember, this is the RSST definition, which is pretty much adopted. That's how people run them, right? They take the changes and they run them as accruals.
That's how it's done in the academic literature, but if you open up any textbook, intermediate accounting textbook, and look at chapters 3 and 4, you will find that deferrals are referring to what's on the balance sheet.
In the balance in the,
Mm-hmm.
okay, what's on the balance sheet? I mean, this is, okay, you have to take this with RSST and the rest of the literature.
Okay, so, okay. I
But
don't do,
the
but
balance sheet of the accumulation of accruals, right? The current accruals are the changes. Yes.
so go back to say McNichol's 88. She says it's cash equals net income plus accrual adjustments, not accruals, but accrual adjustments. Okay.
I don't know what this means. I have to look it up, I guess.
So it's sort of adjustments to the balance sheet numbers. The accruals are the balance sheet numbers, and you're adjusting them or changing them, which is, a balance sheet perspective that there are accruals on the balance sheet, and if you adjust them, that's going to affect your measure of net income relative to cash flow change. But I think a lot of this problem that we have in the literature is because we use a statement of cash flows approach.
Yes, that's what I'm talking about. That's what I'm talking about.
But I think,
Right, I'm getting to that.
okay.
All right, I think that's exactly what Sudipta was referring to. So, I mean, the short answer, of course, they have accruals, right?
Mhm.
Because real estate firms have operations, so they continually get new accounts receivable and they pay the old ones. So the net result may be zero, all right? But of course you have new accruals, right? I mean, that's not even a question. And of course the quality of accruals can change because the new accounts receivable can have very different customers, very different terms. So but that's what the income statement, the income-oriented concept tells you, right? The problem here is kind of mechanistically applying the asset liability approach, right? You say, hey, no changes, no accruals, right? Well, we're hoping to avoid that, right? How about this negative correlation between accruals and contemporaneous cash flows? That's in a lot of papers, right? some studies hypothesize that higher negative correlation indicates more income smoothing. That's a pretty popular hypothesis. Okay. So is it true? Well, could be, right? I mean, there's certainly income smoothing, and so that exists. But I think before we get that, we have to be clear about the null here. And the null is that accruals, which are about half deferrals, the deferrals are very strongly negatively correlated by cash flows by construction. If you have the right measures, the correlation is -1, right? I mean, that's not even a question. That's just how things work. And then we have some literature, actually several follow-up papers here, which says this negative correlation over time is steadily decreased, and it's close to 0 now, and several papers investigate why this is true. I mean, empirically, that's pretty well established now. But I just want to remind you that this negative correlation between the deferrals and the cash flows, it cannot go away, right? I mean, it's always there. It's not like it can go away. It's obscured by other things, but just to be clear where we're coming from and whether it can disappear over time, I think it would be good to start from there. I don't think this is very clear. So hopefully this paper will help with that.
So don't you think you have to think about mark-to-market adjustments that go into comprehensive income? So you need clean surplus relation for what you're talking about to work.
Yeah, so basically a lot of this market value adjustment, this is what I call accrual proper. And they basically will muck up this relation because we have a lot more of them, the correlation is going down. But be clear to lay out these things, right? Here, what I'm saying is between accruals proper and cash flows, contemporaneous cash flows, the correlation is probably, could be anything, but it's very likely positive in many cases. So example, well, if you have more cash sales, you like to get more credit sales. That's a positive correlation. Okay. Just laying out these things, I think it will help. All right. And if you split the accruals into accruals proper and deferrals, you'll see very different properties. So we should be doing that. That's the whole point here. I think what Sudhita was basically referring to, I think one thing that is a mistake here is that if you're putting, let's say here, you have ARs going from 100 to 110. So this is the accrual we're going to put on the left-hand side. And what are we going to put on the right-hand side? We'll put cash collections. So that's cash flow statement. But it's like apples and oranges, right? One is kind of income-oriented. So is this what you're talking about, right? On the left side, you put the balance sheet measure. So you have to think carefully what they're trying to do here. If you're trying to get to this negative correlation, on the left-hand side, you should be putting what I call deferrals. This is basically which accounts receivable are collected.
Can I say something quickly?
Yes, of course.
Yeah, I think what's missing is a little bit, what is the purpose of accruals? And many of us, when we have to teach and talk about it and do empirical work, we think about accruals are useful because it allows you to forecast future changes in earnings more accurately. In other words, we cannot really think about accruals. What is the proper definition? And that seems to be the discussion degenerates easily. What is the proper definition of accruals? The question at hand is why do we do financial statement analysis? One answer to that question is we want to forecast what will be the change in earnings. And we may also want to forecast what our analysts forecast errors and so forth. But otherwise, if we don't have that, in my mind, the discussion easily degenerates to what is the proper definition of an accrual. And we don't want to have a proper definition of an accrual. We want to have, if we want to engage in the following forecast tasks, then this is where accruals can come into play. And if that's what we're trying to do, this is probably the best definition of accruals. So that's my chipping in.
I mean, thank you for that, and I do think that accounting has a utilitarian perspective, so this utilitarian goal should be had in mind here.
Yeah, I mean, there got to be sort of a purpose of a non-cash accounting. So that's sort of what's lurking in the background. And once we have an implementation of this purpose, then the question is, what do we do with accruals from the perspective of financial statement analysis?
I mean, I would say the answer is pretty clear here. If you're able to successfully split the accruals into deferrals and accruals proper, they'll have very different properties with respect to.
No, that might be, but they have different properties. But why is that important from a practical point of view?
Because they'll have different predictive power and so on.
Of what?
Analysts forecast their future earnings.
Yeah. So why don't you get down to it?
Oh, you want me to?
No, but I mean no, Ilia.
Yes.
All I'm trying to emphasize is that when you write this paper, I think you want to stay away from sort of a philosophical issue. What is an accrual all about? And do we want to refine the analysis and talk about deferrals too? What you want to do is to say, this is sort of our practical problems we face. And if we want to deal with these practical problems, then I think that it helps to distinguish that some accruals are more like deferrals. Because you don't want to get into sort of a philosophical issues, like I can ask you questions. Are deferrals a separate categories from accruals, or is deferrals a subset of accruals? These are not really important questions. The important questions are, there are people who read financial statements. And if you read financial statements, then you try to engage in certain tasks. And then your task is then, this is what you want to keep in mind. So that's just my chipping in. I shall now keep quiet.
Fair enough. I see your point. I mean, there's certainly taste issues here. So I personally do like the more conceptual, philosophical part of it.
Yeah, you want to stay away from philosophical issues. I mean, the last thing we want to deal with is to have a lengthy discussion about what is the proper definition of an accrual.
But I like it, Jim.
So let me jump in a little. So before we had the statement of cash flows in 1988, we had a funds flow statement. And the funds flow statement was trying to explain changes in working capital, not changes in cash. Now, why would you be interested in forecasting changes in working capital? Well, this is basically about liquidity. So you're trying to come up with an analysis of expected liquidity rather than expected cash. And so the accruals or the balance sheet changes are the same, but which side you're putting them on, right? The current assets, current liability changes. You can lump them with cash, or you can lump them with the long-term assets and liabilities. So I agree with Jim that it does depend on what you're trying to analyze. And so, because we did have a funds flow statement from 1971 to 88, so it's, a mandatory one.
Are you asking Jim or me?
You. I agree with Jim that it depends on this thing, but the issue
I mean, look, there could be flavors on this, right? Partly, how do you define cash, right? Is near cash enough? Jim has written about these things. I see no problem there. I think partly the division might have to do with utilitarian purposes. But at least for me, it was helpful for me to lay it out. And the utilitarian purposes, I mean, I'm certainly that, this is where it's going. Where it will be in this particular paper, I don't know. I mean, I just wrote it, so what happens? I do like the a little more conceptual. See what happens. Okay, how about this one? This is a fun one. So a firm distributes $100 in marketable securities as dividend to shareholders. Is this an accrual? Can you
say that again?
That's what's on the slide, number 4.
Oh, yeah, my eyes are poor. I'm sorry.
Firm distributes $100 in market securities as dividend to its shareholders. Is this an accrual? Can you
No,
take
it has no impact on income. If I
That's my
understand things.
point. That's my point, right? So
Well, it does have an impact on retained earnings though. So it's just not going through the income statement.
No, but yeah.
so it's an interesting one, right? So if you kind of follow mechanistically the balance sheet oriented concept, it's got to be an accrual, right? I mean,
Mhm.
cash assets or liabilities, but if
No,
you count income, it doesn't affect income, right?
Well, I mean, again, I don't really want to chip in. I think about it very differently. In other words, you cannot have accruals in the accounting for cash and marketable securities and financial obligations.
Okay, all right.
In other words, it is not true that the change in all assets and all liabilities are accruals. Really, what you have to do is to eliminate you have to identify the cash and cash equivalent you have assets which are not accrual accounting. You have liabilities that are non-accrual accounting. Then you have a remaining assets and liabilities. That's when you take the net change. So when it comes back to the accounts receivable, you have a choice. You could classify it as if it were financial assets. And I think that's sort of in my mind what Steve is doing. Or you can classify it as a non-financial assets. So that's sort of just my way of thinking. All right, I should keep quiet. I find it very the discussion in my mind, for what it's worth, and I'm probably semi-ignorant, I find the discussions about accrual accounting very chaotic.
Well, that's where it started from, right?
Yeah, no, but what I'm saying is why don't you stipulate this is how I view accrual accounting? And once you've done that, you say this is what the purpose of analysis is. There's got to be some sense of purpose here. In my mind, I'm sorry, yeah.
No, fair enough. I mean, otherwise, some of these things, how can it, the imponderables, right? Chicken or egg kind of problem.
No, they are ponderables, because one purpose, for example, with a reading financial statement, I want to know about the accruals, because the accruals, once they are in place, they set you up for more aggressive accounting and less aggressive accounting, and the whole reasons for earnings management in accrual accounting. So that's sort of one thing which is very important from a practical point of view. In other words, it comes down to, I have to try to forecast the change in earnings. When I try to forecast the change in earnings, I like to engage in something that's called a distinction between the cash flows and the accrual flows. So that's sort of one way of thinking about it.
Yeah.
It may be eccentric and it may not be what you want to do. Of course, that's true. That's fine. But that's sort of really what we're looking for. In other words, suppose someone asks you, are there good reasons for caring about accrual accounting? Because what we're trying to do is to forecast the change in net income. What would be your answer?
Yeah, this is further down the road than I am currently. So I do want to hammer very strongly on this basic distinction between deferrals and accruals proper. And if you want to take it further, I think you could redefine basically accruals to be only accruals proper, and deferrals are like this.
Well, fine. Everything is fine with me. It's just a question of what is the purpose of identifying accruals and deferrals? What's the purpose?
I mean, very different properties. But let me wrap up here. I do want to say a
Yeah,
couple
we have 1 minute left. Yeah.
Okay.
So, I mean, maybe we should spend more time on this, but how are we going to split the deferrals from accrual proper, assuming I got you on board here that this is important? Well, if you have the right data, like I had it on the slides, it's easy. There's no problem. Unfortunately, with real life data in the current financial statements, pretty hard. And the big thing is that they don't articulate except for some of the bottom lines. And so it's pretty messy. The cash flow statement is a mess, and it's just You need a direct cash flow statement if you have articulate financial statements, but that's not gonna happen, right? We don't have that. Although in Europe and China, I guess they have some of that. One practical, messy way, the Dichev and Owens paper in Rust 2024 gives you some idea along these lines. And I think if I had to summarize the key idea here to do that is the deferrals correlate strongly with the current cash flows negatively, and the accruals proper with the past and future cash flows. This is kind of the lodestar here, and I'm not sure how good this is. I have to think more about it, but that's my current thinking at least. Policy implications. So again, I'm gonna say a couple of things here. Man, it will be really nice to have financial statements that articulate. Steve Payman has written about this, and I'm a big proponent. I mean, this is all kinds of good benefits, many benefits. I mean, the MBA students are so confused by this stuff. It's just explain a cash flow statement. If you have financial statement that articulate, it will be really nice. And then I guess the other big idea here is that income is really, it's not so much changes in net assets. This is how the FASB thinks about it. It's really about adjusted cash flows, adjusted net cash flows. So that's what the income-oriented view is. So how this plays out in specific statements, that's another thing. But I think that's missing, like in the big picture. Okay, so conclusion, pretty much what I said here. There's this critical distinction between deferrals and accruals proper, which I want to emphasize. It's not well appreciated, certainly not practiced. There's a lot of confusions about it, as a lot of you said. So thank you very much for the comments, and it's good we have a recording so I can review them. I think it was really stimulating, and I developed the paper further. Finally, a reminder here for next time. Yes, Ayung?
Yeah, thank you.
So notice that presentation, we have Andrew Jackson from Sydney. So it's in the evening, 7 to 8 p.m. And Ayung, do you want to add anything to this?
No, I think that it would be a different time. Otherwise, AJ need to wake up in the middle of the night, and then that is not nice. Okay,
Yeah.
so I'm going to stop recording, and everybody is welcome to stay on and interacting with Ilia. Okay.